Since the last time I mentioned one of these dividend stocks that I'm bringing to your attention yet again, it has already soared by over 16%. However, in my opinion, this one stock, along with the 5 other dividend stocks that I'm going to be breaking down today, are still strong buys. And a matter of fact, I'm about to double down on my stances with them, as I'm only predicting that each of them are going to run up as our economic environment turns around for the better. Now, speaking of some big picture news, indices have been soaring, in my portfolio actually just hit some all-time highs because of it, after robust big bank earnings and even some strong tech stock earnings. But don't get too riled up and excited, as this is typical of earnings season. That is all this emotional investing. Now, on the economic front specifically, this week we're gearing up for a consumer sentiment report, which based off the last one actually depicted a souring mood given overall higher prices, whether that's in the grocery store or at the gas pump. And on a more positive note, we're seeing that mortgage prices have come down, and without much news out of the Federal Reserve, it's really likely just to be quite a green week overall. So if you're really looking to gear up and go shopping for dividend stocks this week, just make sure they're at or below fair value, and don't get sidetracked by, again, all the emotional highs that are on Wall Street right now. With that, I want to go ahead and kick it off with the one stock that I already alluded to that jumped by over 16% since I last mentioned it. We have Nike, ticker symbol NKE. And I think it goes without saying that it's one of the most dominant footwear and athletic wear brands, with that iconic swoosh maintaining its global presence, which in my opinion is actually one of the main contributing bullish factors to owning it in the first place, as long as you can buy it at the right price. And that time actually I think is right now, as it's still battered down in the red, down by over 22% on the year. Now click to the 5-year here with me to actually see that Nike has a lot of potential in an economic environment where consumers feel that they can actually spend and have the money to do so. We see Nike back just after 2020 soaring and then coming right back down as economic pressures intensified. But bear in mind the direction that we're actually heading in right now is very optimistic in that bullish run cycle. Therefore, we got to look to the revenues, which we can see healthy influxes of a flow, and continuing down here to that balance sheet where we get assets well over liabilities year over year. Now, if you're looking to get down to dividend business, we're going to go ahead and click over to Simply Safe Dividends to see a 99 safety score along with Nike's 1.78% dividend yield, which is supported by a 40% payout ratio after 40 years worth of a dividend streak and a solid 15% average growth rate over the last 20 years. And of course, Simply Safe Dividends, as of this video, is actually sharing that it's reasonably valued right now. But if Nike seems a bit too risky for you, just being in the apparel business, we can actually orient ourselves with a very necessary service-oriented business, especially when the economy comes roaring back. So let's go ahead and talk about Robert Half, ticker symbol RHI, which offers talent solutions and business consulting services throughout North and South America, as well as across Europe, Asia, and Australia. It has a growing global presence. Now, it's really the run-of-the-mill recruiting service, but its sheer power and size just makes it a force not to be reckoned with, and it's a story very similar to Nike. It's down overall by 22% year to date, which makes a good deal of sense as companies have been waiting for an economic turnaround to actually start to hire again. But click to the 5-year view to see a nice run-up after COVID. Again, you got to look at what's happening during that period of time when businesses can grow. Scrolling down, we can discover a very healthy flow of revenue on their income statement and a very clean balance sheet as well, with assets that hit records just this past year in 2023, topping $3 billion in assets compared to liabilities at just $1.4 billion. And dividend-wise, we're talking about another solid catch with a dividend safety score coming in at 80, which is lower than Nike, but a much higher dividend yield to enjoy here at 3.2%. Now, we do get a bit of a cautionary red flag here with this payout ratio at 67%, which is on the higher side, but we see a solid 19-year dividend history, which should shore up some confidence. And as a shareholder, the dividend growth remains quite strong at an average growth rate there of 12% year over year, as we're seeing signs right now of an undervalued stock as we speak. But we can really reel it in a much safer direction and not go towards the Nike or the Robert Halfs of the world, but dive into Canadian National Rail, ticker symbol CNI. Now, I've mentioned it a few times on the channel, but it's a dominant logistics pick with over 20,000 miles worth of rail that span across Canada and into the United States, and more importantly is understanding their wide array of loads from automotive and coal to fertilizers, temperature controlled cargo, forest products, grain, metal, and minerals, as well as petroleum and chemicals and consumer goods. Talking about a boatload of logistics operations, so a necessity to our everyday lives. Therefore, when it's impacted by higher interest rates and inflation, I mean, it really does result in some damage, resulting in 10% worth of a decline here on the year. But zoom out to the 5-year over 30% 40% worth of share price appreciation overall. And if my projections are correct for this bullish future, well, it's going to be looking bright. Scrolling down, we can actually go ahead and see a nice income statement once again that reads of healthy inflows of revenue year over year, along with a clean balance sheet reflecting north of $52 billion in assets in 2023, with just $32 billion there in liabilities. However, let's just jump right over to SimpliSafe Dividends. This is why I'm most bullish on Canadian National and why I love it. Safety score of a 97, coming in with a dividend yield at 2.16%. And in terms of another key metric, we're going to discover a payout ratio coming in much lower for the companies within the industry here at 45%, along with a strong 27-year dividend history and a very fast growth rate coming in at 16% year over year, at least for the last 20 years. Not to mention, it is another undervalued pick that we have on our hands with Canadian National as well. With that, investors, 3 officially down, 3 more dividend stocks to go. But before I cover the remaining 3, I'm calling on all of you right now who aren't subscribed to this channel, but continue to tune in every single week. There's about 70% of you out there who are on that boat, and I'm going to come right out and share it. Your following is needed and wanted here because I'm truly trying to grow this YouTube channel and take it on full time, but that requires your help to do it. Now, it'd also be a great help to tap on that thumbs up button to let me know that you like content just like this and you want me to produce more of it. Now, last but not least, I do have a new newsletter, the Wall Street Word, that I'm just gearing up to release, full of stock ideas, both dividend and growth stock picks, macro insights, Wall Street professional insights that are chiming in, and so much more. So subscribe to that newsletter down in my description. But with that, we're just going to get right back to it with Power Integrations, ticker symbol POWI, which designs and manufactures analog and mixed signal integrated circuits, or CIs for short, at least what they call them in the business, which are used in a range of products that you're using in your everyday life, like cell phone chargers, appliances, LCD monitors, TVs, LED lighting, just to name a handful of core products that ICs touch. Now, in knowing that their role in our everyday lives is really this important, I like to see the opportunity here in investing into the company Power Integrations that's trading for $64 per share right now. That's down by over 20% on the year, and zooming out, we are going to see that it just about hit 40% worth of share price appreciation. And of course, it wouldn't be on today's list without a healthy income statement and a very clean balance sheet to go along with all of the above, assets trumping liabilities here year in and year out. Now, what you will certainly get with Power Integrations is another dividend growth pick that makes the list today because it's coming in with that safety score at 82, a dividend yield at 1.25%. But I, of course, am honestly going to share with you that the payout is really something that you have to keep your eye on with Power Integrations. It's a tad high at 69% after 15 years worth of a dividend streak. But a green flag here with this 17% growth rate that Power Integrations offered and averaged over the last 10-year period. And we also have with Power Integrations an undervalued pick here as well. As for the last 2 dividend stocks, I'm actually most bullish on them for the next 10, 20, 30, heck, even 40 years out. Let's talk Microsoft first, which I don't really think needs the introduction, so we'll get right to it here with the major news of their recent sell-off and why it's just been really stagnant over the past 3-6 months. And that comes from disappointing cloud growth to a global data fiasco rendered by a Windows-related software update failure at CrowdStrike. However, this is Microsoft we're talking about and one of our AI leaders. So seeing Microsoft at its current levels here, trading for $418 per share from around $460 per share back in July, is a major opportunity if you're really looking for a long-term growth opportunity. Now, year to date, it remains strong and up by just about 12%. And on the last 5-year period here, we're seeing that it shined bright at over 200% worth of share price appreciation, along with a clean income statement and rock solid balance sheet. Now, Microsoft is really a give it some time for a comeback type of opportunity right now. And that's coming from a mega Apple fan over here. So take that for what it's worth. Now, dividend wise, of course, a 99 on the safety score, given the small but mighty dividend yield at 0.79%. Whereas we are talking about a 25% payout ratio and an 18-year dividend streak already, while Microsoft continues to hike that dividend yield at a growth rate of 16% year over year. And most favorably here in terms of SimpliSafe Dividends is also their stamp of approval, rating Microsoft a powerhouse here, a reasonably valued pick right now. But investors, if there was one stock that I had to buy literally right after this video and load up on, it would be United Health, ticker symbol UNH. And a matter of fact, I did exactly that this past week. You could see that in my recent portfolio update, whereas I bought just about $5,000 worth of United Health, making it a 2025 stock in focus for me. United Health is one of America's largest healthcare providers, and with the healthcare system in the United States as is, it makes the stock a no-brainer, at least in my mind, especially as it falters, as it fell from $600 per share to $560 $69 per share recently. However, United Health has remained up on the year by about 5.6%. And my only real regret with United Health is not buying it back in March and April when I mentioned it to all of you. But as you can see, over the last 5 years, we have a powerhouse of a dividend growth stock on our hands, appreciating by over 132%, coming in with an insanely healthy revenue flow as well, again, given the nature of what they do as an insurance provider, and a very clean balance sheet, which was what I love to see, topping $273 billion in assets. However, as an investor in my 30s and an absolute necessity to seek out dividend growth right now, United Health literally is that no-brainer stock pick for me. So clicking into SimpliSafe Dividends, we get a safety score of a 99, comes in with a dividend yield at 1.47%, with a payout ratio here sitting at just 29% while maintaining a 31-year dividend streak, while delivering through on a powerful 41% average growth rate, which is just unheard of. And now the icing on the cake for all of us is actually that it's coming in as reasonably valued from SimpliSafe Dividends as well. With that, those are my 6 dividend stocks that I want you to watch this week. Comment down below with your thoughts on these dividend stocks, or if you're focused on other opportunities. Let us all know down there in the comments. Click right here if you're actually not sitting on $100,000 in your brokerage account to learn how to get there much faster than you are. Be sure you're subscribed, and I'll catch you in the next one.